Well, thank you very much for a nice welcome, and I really sincerely feel it's an honour to be here from Salt Lake and in front of you guys. And hopefully I'll be able to partake a little bit of information and pass to you, and look forward to your salient views at the cocktails afterwards. So please give me feedback as to whether or not you think there might be a gem of gold in a few things I might have to say, or that you want to retort and debate. So with that in mind, see, where would we be without a technology pitch in a technology conference? It's expected. So you might hear, oh, I lost my, okay, we're there, hopefully. What time is it, cocktails now? Let's go. Yeah, you might hear me reference a couple of times during the actual presentation that there's a book out. And for those lucky few, I've been able to bring a few from the UK. So if you're interested, you can get them outside. But I might reference and promote it once again, unselfishly. You'll find that the basic topic today is going to be, okay, we got finally there. So what I want to try and cover today is a little bit about some perspectives about investment and the perspective that there could be actually unrealized value. So I'll cover what does that really mean, because fundamentally it's going to be telling us exactly how we might want to get at more effectively managing our investments through categorizing them and treating them different. We tend to actually manage investments very similar across all different IT spend. So I want to talk a little bit about that. It fundamentally gets at, if we do that right, we can start driving at this intellectual capital idea. I want to talk about then some more effective ways of triangulating the value, and then we'll look at managing value after that in terms of capturing, enabling, optimizing and realizing it. And then finally, I want to give you some concepts about forward thinking around network advantage. Network advantage is something I'm calling sustained competitive advantage. So let's talk and discover a little bit more what that means. And then I'd like to give you a kind of a challenge at the end to maybe think about over cocktails later, or at least the first 1 or 2 drinks. So let's talk about unrealized value. One of the things we must be appreciative of is that, I'm breaking up with this. It's coming in and out, it's breaking in and out. Actually, can you hear me in the back? No. Okay. Can you hear me now? Okay. So one of the things I think is very prevalent that we should really understand is there's $3 trillion worth of IT telecom spend globally. And it hasn't dissipated at all in the last few years since the internet downfall, or indeed the banking crisis. It continues to grow. Clearly in the 2000s it's more in the single digits, but as you get into the 1990s, it was going up into the mid-teenage digits, anywhere between 12 and 16%. So it hasn't waned at all. $3 trillion. So there's me thinking, well, what is that doing? It's certainly something like 3 times out of the Indian gross domestic product, to give you some sense in terms of its size and perspective. And one of the things that particularly concerns me when I look at that trend and I look at the research, there is no correlation to profitability. There is no really defined value statement on that $3 trillion spend. And that's something I'd like to explore a little more. So if you look at Strassman and various people like Glothoff, you'll see that essentially there's been a lot of research that proves productivity. In other words, if we spend IT money, spend it, or indeed invest it, you'll see that there is indeed a correlation to an improved labour productivity, a corporate moving more effectively. But when you try and then correlate it to profitability, i.e., does it actually materially impact the bottom line, there is no proven empirical research to actually say, yes, it happens. And the reason for that is, between productivity and profitability, it dissipates. In other words, the money is not actually captured, the value is in fact used for other purposes, and it's not demonstrably correlated back to that original investment, and so profitability is not defined. So one of the reasons that I'm advocating as we move forward is that we need to start thinking about moving from the industrial age of asset-based accounting to a more of an information age of intangible or intellectual capital evaluation. Because essentially, as we go through the presentation, you'll see that 80% of market value cap, the capitalization of firms' market value, constitutes 80% of intellectual capital, residue value, intangible value. So we need to move away from assets to competencies. And that's one of the things I think we start thinking about as a theme as we go through this. The things that I also want to demonstrate is not only are we incorrectly looking at how we're valuing or measuring those investments, we're also not managing them effectively. As illustrated in, for instance, the Standish Group's 2004 report, citing in America alone, we have $250 billion worth of project investment, IT investment, 55 billion of that is wasted. Literally only 1 in 3 projects are successful. So why is that? It's improved over the last 3 years or so. The improvement's been there, but it's not sustainable at that level of wastage. So there's a couple of things here. One, we're finding out that we're inappropriately managing and measuring IT investment. And secondly, we're not actually understanding the real value of intellectual capital. You have to excuse me a second. Intellectual capital, as I say, constitutes about 80% of the market cap. And what we typically find that we're visibly only measuring the return on investment on the tangible asset. So what does that mean? The infrastructure, the software, any labour associated with the software development or design can be capitalised. What we're finding now is we move to managed services, managed service provider, service in the cloud. We're finding most of our costs now are moving from a traditional asset capital to very much an expense item. So the whole perspective now on how you define and understand its value must change equally. And yet traditionally we still continue with the old accounting principles of how we measure the asset of an IT spend. So think about that. We're moving from a fundamentally large hardware, software, asset capitalization to service-based, expense-based services and indeed information provisioning. And what that means is we have to think from the industrial age of traditional accounting to essentially a more emerging understanding of value in intellectual capital and intangible value. Let's think about then, okay, with that as a backdrop statement, let's understand then, well, what is it we're talking about in terms of investments? Let's understand, first of all, what's driving intellectual capital. You know, again, it's probably a very poor slide for those at the back, but all I'm trying to say here is essentially we're moving away from traditional based software, systems, infrastructure. We're looking at more of that service-enabled capability. We have to start thinking of growth options for agility and flexibility in meeting new market demands and time to market, time to profit. In other words, the speed in which we're applying the technology is going at such a rate, we need to again think about what is an effective way of measuring the effectiveness of that investment. It's certainly not going to be over the 3-year depreciation of a particular hardware asset. You've got the service-oriented architecture, you've got the cloud, you've got essentially real-time computing, business intelligence, virtualize anything. Any client, any virtual person in this world can work on a virtual client, on a virtual server, in a virtual application, hosted in a virtual environment. This is real today, and it has been for some time. We call this something called the cloud. It's been around for many years in terms of the capability. We have to understand what does that mean in terms of the business drivers and the dynamics around that investment. We'll talk a little bit more, therefore, later on, certainly in our panel discussion, about those investment trends and drives and the impact it's having both to the market, the application, and the definition of its value. What this all requires is a lot more of a higher view as to how we account for that investment. We have to do that at the strategic business level. It is no longer acceptable or plausible to have a lag IT strategy to meet a business strategy. You cannot wait that 6 months, those 2 quarters, those 3 quarters of an IT strategy trying to catch up in a supportive business strategy perspective. It has to fundamentally be integrated on the onset of the business strategy itself. In only that way do you fundamentally get at a drive on the business drivers associated to that intangible value, that intellectual capital. You have to make that move now in getting a better alignment with your peers and indeed the CEO to ensure you're at the table making the business driving decisions, not a business supporting decision. We must think about equally the importance of introducing and investing in agility and flexibility with our overall IT infrastructure and investment. No longer again, I'm going way beyond proprietary stuff. I'm going way into literally thinking about an open system that has fundamental investments already incorporated so that if indeed you need to change to the market, if you need to respond to a new imperative business objective, you can do so instantly within the quarter, a web year. Think about 3 months as a web year. We need to think about that responsiveness, that ability to make that incisive decision in that period to be competitive and sustain competitive advantage for the company. Having said all that, we also have the base infrastructure and we have a legacy infrastructure. We need to understand how to better utilize that in a new environment that's open and indeed service-based and indeed in this virtual environment. We need to see much more effectively how we can leverage those investments. And so we must think about the IT investment as a portfolio. We have to look at it just as you would an individual wealth management scheme or an investment management scheme. You need to think about how on earth do we look at those investments and how do we turn the asset into essentially a capability. So with that in mind, some people may have seen something similar to this. I apologize because it's probably very poor to see it at the back there. But here we're talking about a shared infrastructure. So we're moving well away from proprietary or indeed individual business unit driven infrastructure. This is shared. So this is basically, you've already made that quantum and that leap in terms of understanding the importance of sharing across the business units and the corporation. Here we're trying to optimize costs. That's the driver, optimize the cost. It's still critical to invest in, but we want to optimize it. We're clearly trying to bring down the overall cost of doing business, but the driver here is optimizing the cost on operational efficiency. That's what we should do with that shared infrastructure. As we come across to the systems operational side, we're now trying to optimize the returns. Typically, you're looking at short-term, medium-term driven ROI. And here's where we need to basically optimize that returns because we're moving from operational efficiency to operational improvement or productivity. As we go up into the service investment, we are investing in IT services from a stakeholder perspective, and here we're looking at basically improving or maximizing the benefits to the corporation. I say benefits because it now gets broader. You're talking about stakeholders' perceptions of reality. You're talking about their expectation. And ultimately, over time, if we don't produce a return on investment that drives stock price, market valuation, clearly we're not going to be able to sustain it. But it takes time for major investments to materialize and provide that return on investment that's very strong. Therefore, in the short term, medium term, you have to focus on the principal stakeholders in your value system to ensure that you're capturing their perception of value and you're realizing it in the eyes of the holders of the marketing VP, of the supply chain VP, of the CEO. Here, we then really want to move to where the high return is over time. And the high return over the time is in that informational strategic area. And here what you're trying to do is maximize the returns. You're maximizing exactly the returns to the company over a longer period of time. So now you have to start thinking about obviously balancing these 4 quadrants of investments. You've probably heard it before that you'll see anywhere between 60 and 80% in these two categories. Infrastructure could be around 50, you put another 30% on the operational application investment, typically around 80% in the first two quadrants at the bottom, where essentially you're only looking at operational productivity and efficiency. You do nothing else but trying to improve the throughput in a return basis. Where we need to move is start looking at how to maximize, not just optimize, maximize that return. Give you some examples of the migration. We can start looking at shared services and computer telephony integration opportunities in terms of the service provisioning. We can look at online processing for e-business. We can move into supply chain, supply integration. Here, it's not just supply chain within the company, within the value chain. It's the value system. The importance today is the extended value chain, or the value system, as Porter would say. And what that means is it not only goes to the customer, supplier, partners and alliances. If we don't leverage those four stakeholders, ultimately you're not maximising the return in your company. All you do is optimising within the four walls of the firm. So the importance here is extending that value network. I'll talk more about that later. The important thing is, how do we move this? It's not all going to be able to move across, but one of the things you start thinking about, if I'm spending 80% down here, how do I spend 1 more percent and essentially provide a higher value up here? In other words, what options should I be investing in that 80% that then gives me ability to provide a higher return that I can maximise as a service or information provision? So having given that perspective, we looked at value is wasted. There's a lot of money on the table, and the suppliers will be happy to know that, I would imagine. There's probably a lot of money on the table right here. We understand it's not been optimised. The value is questionable. We haven't got effective ways of measuring it. We need to start moving from the industrial age to the information age, from assets to indeed capability. We need to start working on our intellectual capital. We can only do that if we start looking at managing the investments on a whole and how to manage it as a portfolio. And now we've got to hone in and think about how we want to triangulate the value. So essentially we need to look at IT value creation within the company. Traditional financial and accounting techniques are fraught with problems. Over a few drinks, I'm more than happy, and if there's a few accountants in the table here, I know they're not normally allowed in to a think tank like this, but if there's a few accountants, I'd love to have a debate with you. The issue is finance and accounting look at historic asset management, nothing to do with future. Nothing to do with the future residue value that's driving market cap. So we're basically making decisions on history. And we're not effectively using the right measurements to allow us for the right decisions for the future. We're also looking at the fact that there are many organisational or conventional organisational-based methods. We need to look more aggressively, specifically on information economics, ways of being able to understand how to determine that value. So all I'm saying is, we're not going to get away from the return on investment or the traditional accounting techniques today. We're going to have to live with them, and probably rightly so, but calibrate it. Triangulate it with one or two other measures that are more future, forward-thinking, so that you make the optimal decisions. You don't make it on a historical perspective. Give you an idea, I talk about four value lenses that would make up an index. And all you could possibly consider is, hey, instead of just return on investment, which might be an operational lens, let's take a strategic lens, which may be looking at, for instance, meeting a market share opportunity, a market objective, a price point, a customer, new business opportunity, a new product introduction. What is it that we can do to start driving a strategic objective in alignment? And then look at agility. What gives us an investment that we can make, maybe in open systems, that ensures that when we actually do have to acknowledge a business change in direction, we can actually deliver a capability in IT within a quarter, not a year, not 18 months. And then we look at stakeholder. Maybe that's a satisfaction rating, perception of value. How do we define that? So the point being is, don't just rely on the one accounting, return on investment, or discounted cash flow, think about 1, 2, or 3 other measures that then triangulate the real value of the investment, and more specifically, goes beyond the tangible asset return on investment, treats the intangible value with equal respect in a decision on the investment value. We can then start building a little portfolio, and you can see there the black holes. We don't want to invest in any of that. But you can see 1, 2, 3, 4. These are perhaps opportunities that we can be talking about in terms of investments that drives both a long-term, or short to long-term investment and stakeholder value. One slide I want to show you in capturing, enabling, optimizing, and realizing the value is just the metrics I've come up with. Again, I'm not sure if it's coming out the back, but we want to move from value capture and recognize what the drivers on value capture are. And essentially, we're talking about the value system, the value chain, value system, process management within the company, not within IT, across the company. And I'm going to talk more about the importance of that later. We then also need to couple that with something you're all too familiar with, is if not aligned, but certainly should be striving to integrate to the business strategy from a portfolio point of view. And then we move into value enabling, which then transitions into really defining. And this is what we're not good at as CIOs. We're not good at understanding the capability and capacity issues. And I don't just mean that we've got bandwidth, or do we have a response time issue. I'm talking about, do we have the talent in the organization? Do we have the flexibility in the IT investment to respond to the business requirements based on the strategy and the value system? So we're very good at understanding. We have people in the organization, we have some skill sets, we have a basic understanding of the assets in an IT investment from an infrastructure and systems point of view. We're not very good at understanding, well, what do I need to migrate to? What's the future state I need to transition my talent to, transition my infrastructure, and indeed application base to, in order to liberate investment and drive the service and information strategies. We then will go into value optimization, and we've got to understand project and system management, service and information management. So here's we start going to now optimizing the value. If we capture it right, we enable it through the capability of services, we can now optimize it the way we manage those investments and operations. And then, of course, to start realizing it, we start seeing the impact it's having to our extended stakeholder. Four slides on network advantage. And again, what I'm calling network advantage is essentially sustained competitive advantage, right? So now we're saying, what is the advanced thinking around value systems, value options, value networks, and indeed maximizing the value? What does it tell us that we need to start thinking about in terms of the challenges moving forward? Well, the first thing, value network. I mean, we've heard of social networking, of course, but it's been around for a long time. Essentially, it's all around about stakeholder, social, technical, economic value. It's the combination of technology and the social relationships within the people that we're doing business with, the stakeholders. And it's that I think it takes more attention is required to really understanding what the underlying value perceptions are of our IT spend and management. When we look at that, we really have to start thinking about what is the value of the relationship? What's the value of that member relationship in our network? What's the value of the Dell relationship and the people I have with Dell? No questions, it was a rhetorical question. What about IBM? What about in one of the consultancy companies? What is the actual value exchange? How do I measure that? How do I define that? We talk about partnerships. What does that really mean? How is it demonstrable? What does it actually bring to the firm in terms of value? How do we quantify that instead of rhetoric? All right, and what I mean by that, we talk partnerships too easy. We don't really understand what it's really about. What are the exchanges in the relationship? Clearly, we understand one exchange, the tangible value. You buy this hardware, I give you a price for it. Right? That's well understood. What is not understood is the intangible relationship that should be of a higher value than the actual hardware or tangible asset. I'll give you a perspective on things. I think we should start talking about the chief value or network chief. I'll say that again. We should start thinking about a chief of value networks. Why? We're going to get this into the panel later, but you've got now layers and layers of this cloud constitution, right? Within the corporation, within its value system, within and extended globally. You have these layer of clouds, and there are some wonderful networking member exchanges going on, but we just don't really know how to measure yet. We intrinsically understand its value. We should keep in touch with X, Y, and Z. That has intrinsic value. We don't think about, though, what does that quantify? How do I have a lifetime membership value? Do we talk in those terms? What's the lifetime membership of Dell to our company? How do we realize that? How are we going to measure that? What does it mean in our behaviors? We don't think that way. We look upon it as being eventually either a base transaction or a culmination of several years of transactions, an intent for a partnership with some understanding of what that means, but underlying we don't do enough work in understanding that relationship in terms of value. So I would contest that we might start thinking, move away from chief knowledge officer, and we start thinking about this chief network officer, someone that can understand the value of these relationships, manage them, so that we can actually get a higher return from them. We should start thinking about value network analysis. No, not the mathematical models, not over-engineer this. Think about it just from some basic understanding of the variables that we need to think about in measuring that value in that relationship. I'm going to break a second. Anyone know what the background on this slide is? Can anyone see what the background is? Shout out. Anyone? Close. It's the White House. There's the White House there. I was at a recent, with my good wife here, Rhonda, I was at a recent graduation of my daughter in Washington, D.C. And Michelle Obama was there providing a wonderful presentation. I won't even try and give the salient point she was making, but it did suggest to me that her message to the new students in America was get out, experience the world, build a network, and then come back to America and demonstrate its value. So if Michelle Obama is telling that to 350 Americans, our message back to you is how do we, and I think India is probably taking a leadership role in this area, how do you get out and come back and build? It's the membership relationship that's critical, especially in the outsourcing deal that I'm probably lecturing to already believers here. Second one, value systems. So we mentioned before, it goes beyond the value chain. This is so critical. So we talk, you know, the value system must include your customers, your suppliers, your partners and alliances. We need to understand how we can work together in a competitive advantage, a sustained competitive advantage, and build that network. The second thing that's so important is the combination and collaboration of IT and process improvement. Gone are the days in the 1990s when you had enterprise resource planning. I'm sorry, ERP, that big monolithic application out there, CRM, supply chain management, BARM, Siebel, whoever you'd like to call it, this wonderful monolithic application that you threw out there and tried to actually embed into your company. Gone are the days, I believe, that essentially you do a process design and then decide to put your IT solution in. Gone are the days, I think, that you just build your IT from vanilla and expect you compromise with your business process in terms of adoption. The days now, you have to have the IT systems design absolutely integrated with the business process guys. Now this starts an interesting dialogue, doesn't it? Is the CIO dead? Is IT as an organization dead? Should it be integrated? How does the business start building their capability to manage the IT skills? It's happening. You know the dialogue out there. I think it's going to be a number of years before we get the business fully aware of the IT challenges, but it will start, and it will start in the area of process improvement or re-engineering and IT systems design. That's the first big sweet spot. You outsourcers out there, if you can crack that one, where you can embed the process redesign with the IT system design, and I'm not talking about green or vanilla or or best practice. I'm talking about the actual way of working together in the design process. You will be able to be very, very responsive and adaptive to any North American or European company that wants that flexibility without a huge investment of having to go through process redesign or huge systems redesign separate. So once again, think about what capability you can combine together from a systems design and a business process design and offer that as a full solution set back to corporates. And I think you'll find a particularly winning value proposition. So again, the important thing here is the convergence of business process and system design is basically looking at a higher value proposition. So anyone know what the backdrop is? Here? Machu Picchu, exactly, well done, sir. So 2 years ago, my good wife and I were up in Machu Picchu. To me, it's symbolic of a value system. How on earth you had a small organization in the middle of the Andes, inaccessible, and yet its reach was far and wide, all over South and North America in terms of connection. It's that kind of thinking I think we need to change. Value options. Here we're talking about the flexibility, and I want to really harp on this. So there's a concept called real options. So real options is essentially used in financial hedging, financial management. Insurance companies, you're really trying to hedge a bet. You're placing an insurance bet to see if something's going to happen. I can make it happen because I put that bet on. But I don't have to spend the money if I don't want to take the bet. If I don't want to, in other words, realise the investment. So in other words, what you've got here is the opportunity to understand more about when do you make investment decisions. You don't make them if you don't have to. You make them when you need to do it just in time. Because it's only at that point do you have the excellent information, real-time information, to optimize that decision. Of course, there are decisions you'll make when you need to make them. But some of the strategic, some of those ones that have been responsive to the market changes need to happen a lot later in the decision cycle. And at that point, you need to really understand what options can I put in place meanwhile. That when I finally make the decision, I can make a good bet. In other words, the value will increase significantly because it's timely to market. It's time to profit. It's responsive to the organizational change. It's responsive to a business strategic direction. And we're moving so fast now, we need to think about what flexibility and agility we're investing in now in order to make those appropriate decisions later. We need to think about risk management a lot more effectively within IT. Traditionally, it's been done at the corporate level with good governance. But we need to think about moving and understanding the risk strategies within our IT investment. What's the risk of a bad decision? What's the risk of a good one? What's the risk of not making an investment? These are things we don't typically spend a lot of time. We think about what's the decision we need to make, what's the return. We don't typically think about the significant risks that over time we are now directing the ship in a certain direction that may limit us in ability to respond to new directions. So think about understanding the risk of not investing, the risk of investing in a more acute way. Think about embedding options into your investments. What's the backdrop? Anyone know? It's a tricky one. Lake Titicaca in Bolivia. And why do I say value options? This is the Reed community. Not Reed, it's not my community, we're not related in any way, as long as I know. Although my dad, no. The point I'm making is the Reed, the whole community is built on Lake Titicaca of reeds. These are reeds that are actually floating and wound and weaved together to make an island. They put the tents on there, they have a wonderful life, it's very damp, so there's a lot of arthritis. But they also have a TV there, I don't know, God knows where the electricity comes from. But these are floating reed islands. The point of value option, the point of an option is, if this gentleman no longer likes his neighbours, they cut the reed where his tent is, or his shack, and it will paddle away to another reed island and join the new community. So I thought that was a nice analogy of an option that they've designed in their habitat that gives them the flexibility to move respond to change. Maximising shareholder value. So I'm not a big believer in shareholder value. Look, at the end of the day, you have to produce it. Look, whatever I say, one thing I don't want to mislead you. You have to do a return on investment ultimately. You're going to have shareholder value ultimately. If we don't do that, the investment is not maximised. The point I want to make is what you have to do in the meantime. To understand the value is being material and captured beyond the assets. And we have to make more informed decisions beyond the assets to talk about capability and indeed options down the road. So I talk about looking at the stakeholders and really understanding how my relationship with Dell is, how my relationship with IBM is, what is my customer relationship. I want to measure and manage that. I want to understand and articulate that. I want to create a loyalty business model. So think about that. Think about a loyalty business model that ensures, I'm not just talking about customer satisfaction and loyalty, I'm talking about a sustained member relationship that has value, that is unquestionable in terms of its value to both parties concerned. Think about that loyalty branding, that model. Finally, I just want to give you an idea. There's a maturity model. Oh, did I tell you there was a book? It's a very good book. There's a few copies still outside. You're welcome to buy one and I'll sign it. In the book, I give you a maturity model. I'm not going to go through it too much, but it gives you some idea of a tool that you could use to assess where you are on these various dimensions, all right? This gives you an example of the research that I did with a number of companies in North America, where a typical baseline would be. And my final slide, before I get thrown off the stage, talks about a challenge to you guys. So I talk about, one of the most important things is, start off, have a look. This is not a big exercise, guys, and chew off as much as you can handle, right? There's a state of organisational readiness that's important. If your company's happy with where you are, then you probably want to be careful on what changes you make. If your company is cost-driven, then until you change the perceptions of IT should be a business-driven organisation, you're going to have some fundamental limitations. So be careful when applying something like this maturity, but understand there's a quick model, quick checklist you can go through to see whether it sparks an area that's worth pursuing. That's all we're talking about, is reflection at a point to say, you know what, if we pushed on one of the two of these frontiers, we will start moving the company to see things beyond just IT as an asset, just IT as a support organisation, IT as a cost centre. It starts the journey, and the journey is going to be in collaboration. You're going to bring your partners with you and essentially command good decisions as CIOs in terms of choosing the battle tactics wisely and where the biggest impact can be made in that transformation. But the status quo is not acceptable. We're seeing companies in North America and Europe already making advancements of now understanding that we have to move in an integrated business strategy way, driving an intellectual capital. It's becoming a driving force, not just a supporting, sustaining role. My challenge to you is, with all this wonderful stuff, or not, that I might have actually shared with you, what is the actual reason why companies do not put in better measures for intellectual capital? Why? So with that, I would suggest we can have a good stiff drink later on today and perhaps explore that very fully. Thank you very much indeed. Appreciate it.